The stock market has been booming recently between a combination of the Federal Reserve's pivot to interest rate cuts, some positive economic data that has reduced at least some of the concerns about a potential impending recession, and you had Donald Trump's victory in the presidential election along with the Republican Party seizing control of both houses of Congress. That's driving increased optimism that there's going to be significant deregulation, potentially major tax cuts, at the very least, the Trump tax cuts from his previous administration, especially in corporations, being renewed. And so all that is fostering a very bullish atmosphere for the market and for especially big tech and crypto and some other AI stocks, etc. However, there have been some high-yield stocks that have not participated in that recent rally. In fact, some have pulled back sharply, in part due to the fact that there are concerns that the tariffs by the Trump administration that are proposed, as well as just the general bullishness on the economy, may cause inflation to reignite. And so that could hurt some companies that may be perhaps are interest rate sensitive, in addition to just some companies that are facing a few headwinds in their industries right now. In this video, I'm going to talk about two blue chip, high yield dividend growth stocks that I actually really like that are at compelling valuations right now. But before I get into those, if you could please give this video a like, it would really greatly aid in its distribution and help me grow my audience. Thank you so much. Okay, so the first dividend stock that I really like right now is LyondellBasell. In fact, it may be one of my favorite dividend growth stocks right now. And the reasons for this are pretty straightforward. First of all, it is a low-cost producer of plastic-type polymers and olefins, etc. And so it has a low-cost position, which gives it a cost advantage over some of its competitors. That gives it a narrow moat, according to Morningstar's analysis, for example. So its business model is well-positioned. I think it's durable. There's going to be strong demand for these products over the long term. They're also investing in some more renewable recycling-type businesses that also help them prepare for potential future as well, especially in Europe, where they're building these facilities. And so it has a durable and I believe a fairly defensive business model because, again, these are essential products. They've done a good job of minimizing some of their capital exposure to some of these industries, trying to reduce some of their operating leverage. And again, so I think it's pretty defensive, pretty durable business model. But they also have a very strong balance sheet. They have a BBB credit rating from S&P, which is solid. They have a leverage ratio below 2 times, which is quite reasonable. They have billions of dollars in cash and even more in liquidity on their balance sheet with very well laddered debt maturities. And so between that and the significant cash flow that they generate, they have very little concern when it comes to financial matters. Now, in terms of their valuation, first of all, just look at their dividend. It's about 6.5% right now, which compared to its historical average of around 4% looks like an incredible bargain. On top of that, the dividend is very well covered. I think the current payout ratio is around 59%. So there's plenty of difference there. They also generate a ton of free cash flow. And so it's not even just a matter of earnings covered, but they have all these other needs for that cash. I know they generate a lot of excess cash. And so that dividend is very well covered. It's very attractive. And they just hiked it by 7% this year. So it's not like this is a dividend that they're just not planning to grow anymore because they're concerned about their business or their balance sheet or whatever else. They're very confident in this dividend, and so much so that they've been growing it every year at a good mid-single digits CAGR. And this year they even upped the ante and grew it by 7%. Now, I wouldn't necessarily expect them to continue growing it at 7% over the long term, but I think a mid-single digits, around 5%, is certainly reasonable to expect. On top of that, they've also been buying back stock over the past several years, and they've done a pretty good job of doing so on an opportunistic basis. And so when you combine the buyback with the high dividend yield and the strong and steady dividend growth, it's a great stock for investors who like management teams that return a lot of capital to shareholders. But on top of that, they actually have some attractive growth opportunities. They are driving growth in a lot of organic areas. They're investing in, again, their new recycling business in Europe. They're divesting their low-margin refining business. That was a very small part of their business to begin with. They've done a good job of keeping capital exposure to risky markets like China to a minimum, and so that helps reduce some of their geopolitical risks. Again, they're that low-cost producer that helps reduce some of their inflation risks. And so when you combine all that, I think they're going to also continue to grow the business quite substantially moving forward. In fact, management's guidance has been for about 10% earnings per share CAGR for the next several years, and even analysts seem to agree with that. Despite the market's bearishness on the stock as it's pulled back sharply into the low 80s now after being near $100 a share not too long ago, analysts are still projecting about 9% earnings per share CAGR through 2028. So when you combine that 9%, even if it's only an 8 or 7% earnings per share CAGR with the 6.5% dividend yield, the dividend growth, the share buybacks, and the strength and the durability of the business model, I think it's a pretty compelling opportunity to buy into a very powerful dividend growth machine at a very attractive yield. Before I get into the second stock that I really like right now, if you could please subscribe to my channel. I'm getting really close to hitting 4,000 subscribers, and if you could help me get there, that'd really mean a lot to me. Thank you so much. Okay, what is the second stock that I really like right now? Well, it's actually a set of stocks. The triple net lease space in the REIT sector is actually quite attractive right now. Now, if I had to pick a favorite opportunity there, it would be WP Carey. I've talked about them before on this channel, but I even think some stocks like Realty Income and certainly NNN REIT, or former National Retail Properties REIT, those are also attractive opportunities. And the reason I like all of them, but especially WP Carey, is, again, I'm not sold that we're set for this huge economic boom. I think we've been flirting with a recession for a long time. I don't necessarily know that we're going to go into a recession, but I think that we are in for a period of stagflation where the heavy government spending, and I'm hopeful that, for example, the Department of Government Efficiency can cut some of that spending, but it's going to be hard to really put meaningful cuts through Congress. And with the wars and the geopolitical tensions around the world, I think there's still going to be a lot of spending going on on our military, and also the entitlement programs in the United States are coming to a point demographically where those are going to be a huge burden on the budget. So I really am very pessimistic that we're going to be able to balance the budget in the United States anytime soon. So that heavy excess government spending, I think that's going to put a lot of pressure on inflation and on interest rates. And so you need, if you're going to invest in the real estate investment trust space, you need to invest in REITs that have inflation protection, that have strong balance sheets, and that have the ability to withstand economic malaise, because I think inevitably taxes are going to have to go higher at some point to deal with this runaway spending. And so again, I think the economy is going to have a lot of heavy things on it, especially when you consider potential for war in the Middle East, potential for escalation in Europe, potential for China to do something with Taiwan, and sanctions potentially get slapped on them. All that could plunge us into a pretty severe recession. So I really think it is prudent right now to be guarding against the downside scenarios for the economy. JP Morgan CEO Jamie Dimon agrees with me. In fact, he thinks that there's a good chance we will face stagflation, which is, again, higher than normal inflation and weaker than normal economic activity. And so I think WP Carey is uniquely positioned for that, because like its triple net lease peers like Realty Income and REIT, et cetera, it has that defensive triple net lease business model with the long-term leases that are very high priority for the tenant to maintain. So they've done very well in past recessions, whether it be the 08-09 financial crisis, the 2020 COVID crash. They've done great through all those scenarios. But when you have a period of elevated inflation, you also want a triple net lease REIT that has some inflation indexation in its lease as contractual escalators. And Realty Income and NN REIT really don't have that, whereas WP Carey still has the majority of its rental income coming from leases with those contractual CPI-linked escalators. And so I think WP Carey is well positioned to weather that kind of environment. They also have better liquidity now, better ladder debt maturities after they sold off their office assets, as well as exited the asset management business. They've sold off their U-Haul deal, which was a weight on the stock for a while. And so they also have some other opportunities to potentially exit some secondary and tertiary positions to generate further liquidity. And so they really are not that capital market sensitive right now. So if interest rates do go up, the cost of capital goes up, they're not going to be hit too hard in terms of their growth profile. Again, they have those rent escalators to protect them against inflation. They have the very defensive, well-diversified triple net lease business model. By the way, their portfolio is even stronger than normal because they just got rid of their office assets. And so now they have almost entirely warehouse, industrial, and specialty retail properties that all should hold up even better during a recession. So they got that defensive business model. Their dividend also is on a firmer footing despite yielding well over 6%. The payout ratio is below 75%. And so they're going to be able to grow their dividend moving forward, probably in line with their adjusted funds from operation, which again should be pretty solid. And so you're combining a mid-single, 6% plus dividend yield with a probably mid-single digits AFFO per share and dividend per share growth rate over the next 4 to 5 years with relatively low downside risk. There's a lot to like there. And again, I think especially in this investing environment, I think WPC is probably one of the best REITs that you can buy, especially because its stock price is pretty cheap right now. It's pulled back pretty sharply recently because of concerns about elevated interest rates, et cetera. So there you have it. Those are two dividend stocks I think are very attractive that have pulled back sharply and are compelling buys right now. Hopefully this video added some value to you. If it did, again, please give it a like, subscribe to my channel, help me get to those 4,000 subscribers, and let me know in the comments below what other dividend stocks you like right now. Thank you so much. Have a great day.